Hello everybody, what's going on? So today we are talking about SOFI Technologies after Q1 2026 earning report that caused the stock to drop sharply. A lot of investors are feeling disappointed or even worried, but I want to talk through the results with you to step by step and share why I see this as a compelling opportunity rather than a red flag. So let's start with that what actually happened in that quarter because the headline numbers are impressive. SoFi reported adjusted net revenue of roughly $1.1 billion. That's up about 41% from the same period last year. Net income came in at $167 million, more than doubling from the prior year. Adjusted EBITDA jumped 62% to 340 millions, showing strong operating leverage. They deliver record loan origination of 12.2 billions. Across personal loans, student loan, and home loans, member growth was fantastic. They added over 1.1 million new members, pushing the total to 14.7 million. Product per member also grew strongly, reaching 22.2 millions. There are the kind of metrics that show a company firing on multiple cylinders. The lending business in particular delivered standout growth with net income performing well and non-interest revenue stream like interchange fee, brokerage and platform service contributing meaningfully. This mix is important because it makes the business more diversified and higher quality over time. Now, the market reaction was negative largely because management maintained their full year guidance instead of raising it. Some investors interpreted that as a lack of confidence, but let's put that into context. Their original outlook assumed two Federal Reserve rate cut this year. They kept the same guidance even while planning for zero cuts. That tells me the underlying business is performing at or above expectations despite a more challenging interest rate backdrops. To me, that's a sign of resilience, not weakness. One area that showed some softness was technological platform segment. Year over year growth there was lighter than the core financial service business. But this is not the end of the story. SoFi has successfully pivoted toward owning more of the lending on their balance sheet and building direct customer relationships that support higher margin and more predictable revenue. The financial service segment has grown dramatically. Over the past several years, we have seen it, and this quarter continued that trend, even if the headline growth rate moderated slightly from the peak levels. When you zoom out, the big picture is clear. SoFi is no longer just a student loan refinancing company. It has evolved into a full service digital platform offering banking, investing, high income borrowing payment, and more. They are focused on younger, high income customer who use multiple product creates a powerful flywheel effect. As these members add checking account, credit card, brokerage account, and loans, lifetime value increases while acquisition cost stay efficient. Looking at the balance sheet, the deposit continue to grow, which help fund lending at lower cost. Credit quality remains solid because they target reasonable borrowers with a strong financial profiles. This disciplined approach served them well even if the economy slows. Now let's talk about the valuation because this is where the opportunities stand out. After the post-earning drop, SoFi trade at level that look very much reasonable compared to just a few months ago when the stock was near its yearly high. With continued revenue growth in the 30% range and expanding profitability, the forward multiple becomes attractive for a company that still has a significant run ahead. Analysts on the Wall Street have a range of the targets, but many sits well above current price target, with several calling for 40% or more upside over the next 12 months. Of course, price targets are just the estimate and can change, but the direction suggests the Wall Street still sees meaningful growth potential in this company. I want to address the risk honestly, so you have the full picture. Fintech is a competitive space, no doubt. Large banks are improving their digital offering. Interest rates could remain elevated longer than expected, which might pressure net interest margin at some point. Execution risk always exists when scaling multiple product lines, and like any growth company, SoFi need to continue delivering on its number to keep investors' confidence. That said, the positive far outweighed these concerns. In my view, management has shown the ability to adapt. They have built a strong brand with a modern app experience that resonate with customers. They are investing in new areas like crypto and insurance while maintaining profitability. This quarter marked their 10th consecutive profitable quarter, which is a big milestone, I would say, for a company that was unprofitable for not that long ago. Thinking longer term, the addressable market is enormous. Millions of Americans, especially the younger generation, want a better, simpler, more transparent financial experience. SoFi is well positioned to capture a growth share of that market. If they can continue compounding member growth, increase product per member, and maintain healthy credit metrics, revenue and earning have the potential to grow at strong rate for years to come. So, what would success look like over the next few years? I see a path where SoFi become one of the lending digital bank into the United States with diversified revenue, industry-leading margins, and consistent earning growth. That the kind of profile deserve a premium valuation, which could drive significant stock price appreciation from today's level. Of course, nothing is guaranteed in this market. Stock can stay irrational longer than we expect, and macro factor can create volatility. But for investors with a 3 to 5 year horizon who believe in the digital transformation of the finance, SoFi at these price looks like an attractive asymmetric bet. The downside feels somewhat protected by improving fundamentals and profitability, while the upside remains substantial if execution continues. I have been following this name for a while, and the progress they have made is building a real banking charter, scaling deposits, and shifting the revenue mix has been impressive. This latest pullback, while disappointing in short term, reset the risk reward ratio in a way that favors buyer who can look past the noise. If you're already a shareholder, I would view this as a chance to add on weakness rather than sell. If you are on the sidelines, it's worth doing deep research to see if SoFi fits your portfolio. Personally, I'm constructive on the story and believe the market will eventually reward the progress they are making. Now, let's expand on why the growth drivers look sustainable. First, the member acquisition engine is strong and improving. SoFi benefits from word of mouth, competitive rates, and an easy to use platform. As they layer on more service, retention and engagement should keep rising. Second, their data and technology advantage allow better underwriting, personalized offers, and lower cost. Third, the shift toward fee-based income reduce reliance on interest rates alone. Over time, this creates a more stable earning profit that the market will likely pay for. I also like that they are not resetting on their laurels. Expansion into adjacent product positions them to capture more of each customer's financial life. In a world where customers are overwhelmed by multiple apps, a single trusted platform has real appeal. Execution here lead to accelerating across sell rate and higher revenue per user. Comparing SoFi to where it was even 2 years ago show tremendous progress on profitability and scale. They have proven they can grow fast while becoming more efficient. That combination is rare in the fintech and should support multiple expansion as the company matures. To wrap up my thoughts, This earning reaction feels like classic short term noise around a long term compounding story. The fundamentals are pointing higher. The valuation has reset to more attractive level and the strategic direction remains on the track for patient investors focused on where the company will be in 2027 to 2028 and beyond that. SOFI represent one of the most interesting opportunities in the financial sector right now. And in the end, I would say that the company is executing well, building a stronger business, and the stock is now available at a more reasonable valuation. To me, that combination worth paying attention to. That is the reason why I'm buying at these levels because very soon we will see the price doubling to $30 because if you will notice in within like 2 3 months back it was around $30 level, so there are volume and I believe this year or maybe in the first half of 2027 we will see this stock going at those previous levels, so prepare now. With that said, thank you so much for being here. See you next one.